Welcome to Financial Issues, where we join reality with truth, helping you make the most of your money by honoring God with your investments. Now listen in as we give you the practical tools and advice you need to become a biblically responsible investor.
Good morning. Welcome to Financial Issues. Thanks for tuning in today. I'm your host, Shana, and it is Rapid Fire Friday. Our phone lines are open. If you've got questions, get your call queued up now. The number 610-363-1110. What might you call and ask about? Well, we are a financial ministry, and we educate people about financial issues from a biblical worldview. We are very appreciative of you if you are a partner. This is a listener and partner funded ministry, and we can't continue to do it without you. On today's show, we're going to get to your calls and questions. Again, 610-363-1110. We're going to get to the latest economic information here just in a minute to get you in the know about the financial issues of the day. We're going to get encouragement from the scripture from Joshua 1:9 and see how that encourages us in our stewardship walk with the Lord. Well, at Financial Issues, we help you to stay in the know about the financial issues of the day. We help keep you abreast of what's happening in the economy and the markets and help you understand how all of that impacts your own personal financial issues. So I've got a few takeaways from this week that is ending this Friday, June the 13th of 2025. The official reports for inflation for the month of May are out, and the verdict is that inflation has remained in check. CPI for May, Consumer Price Index, increased 0.1% month over month and sits at 2.4% increase year over year. It ticked up just a little bit from the reading last month. The annual read last month was 2.3. So we've gone from 2.3 to 2.4, not what all of the tariff doomsayers were saying was going to happen. Now, the 6-month change, if you just look at the CPI for the last 6 months, CPI is up 1.85%. Pretty well below the Fed's 2% target. It is likely, though, that inflation could be rising in the next few months, not necessarily because of those tariffs, but because of the very low monthly reads that are going to be falling off of the annual reading. So we've got guys, can you throw chart 1 up there onto the screen? These are the month-over-month changes for CPI over the last year. And if you look back to the far left-hand side of it, you're going to see readings of 0% month-over-month, 0% month-over-month, and 0.1% for May, June, and July of 2024 that are going to be falling off the average. So this will naturally, unless we have readings again at 0, 0, and 0.1, we can expect inflation to tick up just a hair, but I don't think it's going to be anything catastrophic. Core CPI, which excludes food and energy, also increased at a slower pace, 0.1% month over month from last month, and in April the increase was 0.2%. So May was below the 0.3% that was expected, and the annual rate of core inflation held steady after all was said and done at 2.8% year over year. If you annualize those numbers, you're going to get something much lower. The 3-month annualized would be somewhere in the neighborhood of 1 to 2%, and the 6-month annualized would even be lower than the 2.8% that we see now. So it is likely that core CPI will continue to fall. So in PPI, we also got those numbers. That is the producer price index. So that looks at the inputs that producers have, the cost that producers have for the goods and services that they sell to consumers. In March and April, we saw a little bit of deflation. We saw prices actually go down just a hair. So so far, the tariffs are not resulting in increased inflation. Now, I'm not totally convinced that it won't happen, that inflation won't be impacted, since these things do tend to take a while to work through. through the numbers. We had an inventory buildup that happened ahead of the tariffs where smart businesses ordered a lot of extra things that they would be selling to get ahead of those tariffs that might go on. And so we have a little bit of inventory to work through before we see companies actually be forced to raise their prices. But we also might have everything worked out from a tariff perspective before any real increases happen. Economists were wrong the last time about tariffs, the first time that Trump was in office. And if they were so bad, why didn't Biden reverse them? Trueflation, which measures real-time inflation, says that we are experiencing an increase in costs on an annual basis right now of 1.91%. So that was up to date as of yesterday. Let's shift gears a little bit to consumer sentiment. Consumer sentiment is important. It's important to know how the consumer feels about business conditions, about inflation, about whether or not they get to keep their job, because we are a consumer-driven economy. The business and household consumer confidence has been yo-yoing in correlation with the tariff scares, just like the market has. We can see this in chart 2. If we've got that one, we can throw it up there on the screen. As for the expectations piece, there's a lot of moving parts to this survey, but the expectations piece of the survey, those that are expecting a better economy rose 10 points after dropping by a combined 22 points in the previous 2 months in response to the tariff ramp up. Those that are expecting higher sales, the businesses that are expecting higher sales, rose 11 points after declining by 15 over the last 2 months. Those saying it is a good time to expand their businesses, though, only rose 1 point after dropping 3 over the previous 2 months. They're that yo-yo phenomenon. The bottom line from Bill Dunkerberg with the NFIB, the National Federation of Small Businesses, of Independent Businesses, said although optimism recovered slightly in May, uncertainty is still high among small business owners. While the economy will continue to stumble along until major sources of uncertainty resolved, owners reported more positive expectations on business conditions and sales growth. The interesting thing here, I got another chart. Sorry, I got really nerdy with the charts this morning, but we've got another chart 3 to put up there. It's interesting is how small business optimism was really high during Trump's first term. I know you probably can't see the numbers there, but that's the left hand of the screen. You see how during that period you had optimism really high. Then you see that low dip. Well, that was during the Biden years. And then that spike in optimism when Trump got reelected. So small business is very important to our economy. So consumers are expecting lower inflation, and I think we've got another chart to throw up on the screen.
It's chart day, Shana.
It is chart day. So sorry for all the charts. But consumers are expecting lower inflation going forward, as we can see there in chart 4. We had that spike in inflation during all of that excessive stimulus money that went into the economy that has worked its way through, and now consumers are expecting lower inflation. So according to, and there's a couple of surveys that measure what consumers are expecting, the University of Michigan Sentiment Index stabilized, but it is near historic lows since 1952. Consumers say they expect prices to rise at 6.6% in the next year. That's the highest since 1981. In contrast, though, the New York Fed showed expectations for inflation fell. So I guess it depends on who you're asking. So this coincided with Trump rolling back the steep April tariffs. So our team is extremely interested in the AI theme. And speaking of tariffs, these tariff pressures can also be sort of an AI tailwind. The free market system is amazing. It is efficient. It is responsive. It takes in all of the things that are happening in the world around us as it relates to what they're doing, and companies tend to always find the cheese when it moves. I don't know if you've ever, it's a reference to an old business book, but talking about how sweet spots move, the cheese gets moved, and the ones that will move to find it succeed and prosper, and the ones who don't starve.
Find that cheese.
When one variable tends to increase due to forces beyond your control, like tariffs, smart companies will begin to dissect all of their input costs. They'll look at labor. They'll look at where they source products. They'll look at efficiency in their process. So before they consider price increases to their customers and risk running them off and losing market share. So one apparel company in the real world said this: on pricing, we're actively negotiating with retailers and will selectively raise prices. With over 30 in-demand brand across categories, price points, and channels, our portfolio offers strong pricing power. Consumers are willing to pay more when quality and value are clear. We'll hear a little bit more about the workings of the free markets and continue to wrap up the happenings of the week when we come back from this break. I'm your host, Shana Burt. Stay tuned. I've got more right after this.
How is Timothy Plan continuing to lead the fight as you guys now enter your fourth decade of leading this fight of biblically responsible investing?
We've been too silent for too long, and we can no longer be silent. You stand up, like Ronald Reagan said, we're only one generation away from losing all of our liberty. Yeah. It has to be fought for. I wish it didn't. And you can fight for it. You don't need guns and ammunition and that. You can fight for it, especially with your dollars, because it's always about the money. And when the money starts impacting people, they start paying attention. When we launched this, they said it couldn't be done, but here we are 30 years later. They said you couldn't get competitive returns, but here we are.
What a tremendous testament of God's grace.
Go to financialissues.org/Timothy Plans to learn more about Timothy Plan.
Through Crossroads Kids Club, lives like Dali's are being changed all over the world.
When I was 8 years old, my parents separated temporarily. It made me feel lost, empty, and without direction. Until one day, I went with my cousins to the Crossroads Club. This led me to know Lord Jesus and accept Him in my heart. He changed my life, and I don't feel lonely anymore.
Reaching kids with the hope of the gospel in schools and across the world. You can change a young life today at reachourschools.com.
Through the ministry of Preborn, the Financial Issues family has saved tens of thousands of lives of babies. What an amazing job that God has done through you, the Financial Issues family. Would you join us in saving the lives of babies? What an amazing reunion we will have in glory, meeting all the people that we have saved. Please go to preborn.org, that is preborn.org, or financialissues.org, and click on the Preborn banner.
Securities offered through G.A. Reppel & Company, a registered broker-dealer and investment advisor, member FINRA and SIPC. Opinions expressed by Shana are hers alone and are for informational purposes only, and do not necessarily represent those of G.A. Reppel or the outlet on which you are listening. You should consider how the information applies to your situation prior to personally implementing it, and consult any financial professional you work with to make sure it's applicable to your financial plan.
Welcome back to Financial Issues. Thanks for sticking with us. We are live here this morning. If you're watching during the 8 a.m. to 9 a.m. hour, that is Central Time. I'm trying to talk through this music to make it a little bit easier for the guys to edit and put together this In the Know segment, because we do put it in our weekly newsletter. So our weekly newsletter is free to anyone who wants to get it. If you just go to financialissues.org, you won't be there for long, and then there'll be a little pop-up that asks if you want to get our free newsletter. And we do protect your information. We don't sell it. We don't share it. We only use it to send out the newsletter that you sign up for, and nothing else. So Financialissues.org is the place that you can go to get that. So I'll continue here my thoughts that consumers are willing to pay more when quality and value are clear. That is what one retailer said in their most recent earnings release. And so it sounds like the free markets are really taking advantage of the notion that the wealthier are willing to, quote unquote, pay their fair share, because that's what these comments were in reference to. It's a retail company that has 30 different brands, some that have low price points, some that have higher price points. And what they see is that their consumer at the different price points have more elasticity. The higher income consumer has more elasticity than the lower income that are, really restricted by a budget. The people that make more money have more money to spend, and they're willing to do so when there is perceived value. But I wouldn't apply that to the case of taxes, where there's this theory that the rich need to pay their quote unquote fair share, because I don't think there's any perceived value in what we pay to the federal government and the way that they spend our tax dollars. That's been made evidently, painfully clear by what DOJ has uncovered and the outrage that has followed. So the market since last Friday, the Dow is up 0.4% for the week. The S&P is up almost 0.8 of a point, and the NASDAQ 0.8 of a point as well. The NASDAQ and the S&P are within fingertip reach of their all-time highs, and sentiment seems to indicate that they can go higher. Minus the fly in the ointment that came this morning. The pre-markets are indicating a negative open this morning on news of the escalation in the conflict between Israel and Iran. The Dow is indicating an open. The Dow and the S&P are both indicating opens of down 1%, and the NASDAQ is indicating an open of down 1.32%. Oil has spiked at one point, I think, spiking almost 15%. Oil's up 8.2% right now to about $73 a barrel. Probably a knee-jerk reaction, as we've seen that spike in oil come off its high a little bit. It could set the stage for the energy-independent U.S. to be in a very good position as oil prices rise, especially those who have been engaged in the agenda to drill, baby, drill. So what's coming next week? If we look ahead to next week, we get retail sales on Tuesday, and that gives us another indication of how the consumer is holding up. On Wednesday, we'll get housing data that comes out, building permits and housing starts. On Wednesday, the big Fed decision and press conference. The CME Fed Watch tool says that there's a 98% chance of no cuts this meeting, and a 75% chance of no cuts in the July meeting. However, the tool does indicate that there is a 96% chance of a 25 to 50 basis point rate cut by year end. There's a 60% chance of a 25% basis point cut at the September meeting. So that tells us that we're likely to see cuts out of the Fed starting in September. Now, the Fed this next week will likely continue to use the excuses that inflation appears to be under control and the labor market is hanging tough, and they'll use those as reasons not to cut. And in spite of President Trump calling Powell Mr. Too Late and a numbskull, and pretty well demanding a 100 basis point rate cut, I do see Powell continuing to dig in his heels and sit on his hands and refuse not to do the Fed to the rescue dance, even though the Fed has done this on every other political blunder in history. And if you listen to Jay Powell, he hasn't explicitly said it, but it seems to me that he thinks that tariffs are a political blunder. So Trump stated his reason for calling Powell to do the 100 basis point rate cut, the main reason is to save $300 billion in interest payments as we refinance the debt that's coming due, $8 or $9 trillion coming due in the next 12 months. Treasury Secretary Scott Bessent weighed in with his opinion, and he said that the Fed now has a form of TDS, not Trump derangement syndrome, but tariff derangement syndrome. He said 100 basis point cut could, Trump said that the 100 basis point cut could certainly add rocket fuel to the economy, an economy that is simmering right now, by helping unrestrict access. This is not Trump now, this is me. By helping to unrestrict access to capital for small businesses if we do get those rate cuts. If Powell continues to refuse to lower rates, Trump is on his own to stimulate the economy with the tools that he has. And Trump wants to do it the right way. He wants to use deregulation. He wants to use tax cuts and spending cuts to create a real economic boom. What all of this ends up doing is putting the choice of how and where to spend money back to the U.S. citizen, to the taxpayer, rather than giving the money to the government, letting the government decide how to spend it. We, the people, get to choose how to spend our own money. So this will result in a real economic boom, not a flashbang created by the Fed's free money policy or by sending out stimmy checks to the U.S. consumer. Now, if Trump has to go it alone without the help of the Fed, it will likely be a little bit slower than the Fed-induced recoveries that we've seen in the past, and perhaps lingering into the beginning of the midterms. If Americans' patience wear thin, the Democrats have an opportunity to brainwash, or to try to brainwash many into thinking that Trumponomics isn't working. The truth is that Trumponomics can work, but perhaps not as fast as it could with the artificial intervention of the Fed. But at the end of the day, we must get those real spending cuts. As far as the one big, beautiful bill, it's still in the Senate. Fiscal hawks want more spending cuts and are threatening to hold up the process. I think the rhetoric of that is starting to die down a little bit. I think we have to get the bill passed because of the good things that it does. I think that we can still get spending cuts, even if they're not as big as what some would like in this bill. For example, this week, the U.S. House of Representatives passed a slim, beautiful bill that cuts approximately $9.4 billion in previously approved spending that was identified by DOJ as spending that was not in line with what Americans want. I didn't see Elon's response to this, if he had one at all, but I would think that he would be pleased with this, even though the big, beautiful bill doesn't include all of these cuts to wasteful spending that DOJ uncovered. I think that we can see this process play out. So this bill that they passed, that the the House passed, targeted funds for foreign aid, all of that wasteful spending that DOJ uncovered with USAID, and the it claws back some money for public broadcasting, including NPR and PBS. So the LGBT garbage that has been put out on public TV, the Iranian or Iraqi Sesame Street that they were that one of those
interesting.
that were producing. I mean, this is not a good use of our tax dollars. And this legislation is an example of the process of rescission that I mentioned last week, where the House cancels or withdraws previously apportioned funds to claw back those unspent funds on things that they don't think are relevant. So I think the big, beautiful bill should pass, and that the fiscal hawks should keep pressing hard for the spending cuts. So now that you're in the know about the recent and upcoming financial issues, we hope that you'll learn more about how we can help you integrate those issues into your own stewardship. At Financial Issues, we help equip you with the tools to defund darkness and to fund the light through biblically responsible investing and joyful, generous, and obedient giving. Let's shift gears and try to get this stewardship verse for the day in. comes from Joshua 1:9 today. Have I not commanded you, be strong and of good courage. Do not be afraid, nor be dismayed. For the Lord your God is with you wherever you go. Seth? Right.
It's great, Shana. There's not much for me to add to this. We got to trust that God's with us. This verse promises he's with us wherever we go, whether we're in danger or safety. So I hope we can be of good courage, fight the good fight of faith, and trust that God's always with us.
Amen.
Yeah.
I had to ask myself, why does God tell us so many times in the Bible not to be afraid? And what does that have to do with stewardship? Because we're stewardship ministry. Well, fear is false evidence appearing real. It is usually not even based on anything that's happening around us. It's only based on what is happening in our heads. Fear is the opposite of faith. Fear keeps us paralyzed and it keeps us preoccupied. Fear keeps us from doing what God has called us to do with our time, our talent, and our treasure. Faith is all about trusting in God. If we know who God is and we believe what he says, then we have no problem doing what he says. I may feel led to give generously, but fear says, what if I don't have enough? I may feel nudged to serve, but fear whispers, you're not good enough. I may sense that God is calling me to something new, but fear says, you'll fail. Faithfulness requires courage, and courage is not the absence of fear, but the obedience in spite of it. Remember the manager's response about why he had nothing to return to the master except what he was given? His excuse was because he was afraid. He didn't really know God, and he accused God of being harsh and unfair, which is not true. So let's learn from the scriptures. Let's not fear. Let's be free to be faithful and to do what God is calling us to do. Well, folks, if you have to go, we wish you a farewell. Everyone else, stick around. We'll be back with more financial issues.
In the last 10 to 15 years being in ministry, being married, something that has been constant in our lives is Samaritan Ministries. As we've moved, we've had babies, we've had different things come up, we have just been able to rely on Samaritan in ways that we never really even thought about before becoming members.
Our heart's desire is to plant roots and be in a place for a really long time. It's how we were raised. We see the benefits of that, but we also see the open-handedness of being used by the Lord wherever he calls, because we just assumed when we started pursuing church planting, the quickest way to get from point A to point B is a straight line. And with the Lord, sometimes you find out it looks a lot more like this. And yet, Samaritan was with us through the entire thing.
We didn't have to look into, we have to change insurances now because we've moved states or whatever the case may be. And it's just been a real blessing to us in different phases of life.
I'm Kyle.
I'm Colleen.
And we're the Gen X.
And we're Samaritan members.
So I'm trying to plan ahead, and I thought investing would be a good idea. I was going to buy some stock from Back4 Tech Inc.
Yeah, they're actually under investigation for supplying technology that helps human traffickers.
Oh, what about microdrafts?
They support the gambling industry.
U.S. cardboard company, people always need cardboard.
Abortion lobbyists.
How do you know all this?
I just go by the stock list from Financial Issues.
Feel confident and rest assured that your money is not supporting the things that grieve the heart of God. For more information, go to financialissues.org to find out how you can be biblically responsible with your investments. Go to financialissues.org today. Grow your money God's way.
I just love the first book of Exodus. The king says the Jews are too many. Get rid of them. I command you to kill the firstborn. But the midwives to the Hebrews heard the order, and what did they do? They defied it. And God dealt favorably with the midwives and gave them families. He blessed them for loving life. He blessed them for saving babies. We have re-entered the death cult in this country. You think about how much we elevate death, whether it be the chopping off of parts and we call it transgender care, whether it be shouting our abortion, and you see it so beautifully in John 10:10. It is the divide of the entire scriptures. Now, most people would say John 3:16, but think about it. The enemy has come to lie, steal, cheat, and destroy. I have come to give life and life more abundantly. That's the whole ball game, everybody. It is everything. And we have to have the joy of Jesus Christ to enjoy life and to protect it. It's a gift from above. And Preborn is leading the charge.
Welcome back to Financial Issues. Thanks for sticking with us. We are, I'm told by our great social media team that we stream live now on X. I still want to call it Twitter.
Me too, Shana. I know.
Twitter was easier to say, and it was more clever, I think, to say a tweet than a...
Yeah.
X.
Whatever it is in X. Everything about X now under Elon is so much better except the name.
Yeah, I agree. I guess you can't be expected to get everything right all the time.
Exactly.
So, all right. So if you're watching over there, we appreciate you. Interacting with us on social media is a really great way to get us in front of more people, more like-minded people, because, the movement of biblically responsible investing, that's why we exist, really, because we want to teach people good stewardship, and we believe that good stewardship is honoring God with everything that we have, and our wheelhouse tends to be in the investment part of stewardship, and so we give you a way to very practically honor God by screening out the companies that are using shareholder dollars to fund nefarious things, to fund things like abortion and pornography, the LGBTQ agenda, human rights violations, all of those things that as Christians we pray against on a regular basis. So if we're spending our precious time praying against these things happening, then why would we want to support it with the dollars that we're trusted to manage? We don't. So that's why we do biblically responsible investing. We hope that you will too. It is a conviction of the heart. And, just like the scripture says about the Bible, that how can people know if they don't hear? Well, it's the same thing with biblically responsible investing. I think there's a lot of Christians out there that are invested in companies that are not biblically responsible unknowingly, and their dollars are being used to fund the things that they're praying against. So we want to raise awareness about this, and the best way to do that is being on the radio. It's being on the social media outlets and on all of the streaming podcasts. So if you get your content via podcast, you can find us there too on Apple and Spotify, and we even have our own phone app. So the phone app and the website are the ways to make sure that you continue to get this program no matter which outlets we get to stay on or don't get to stay on. So we just encourage you to find us that way. Jeff has been waiting so patiently. Let's go to Jeff. Our phone lines are open after Jeff, so 610-363-1110. You'll be the next caller in the queue. But right now, Jeff, you're live on Financial Issues.
Hey, Jeff, good morning. Are you with us? Shannon, we might have to put Jeff on hold, it would seem. So, Jeff, we'll get right back with you, brother.
All right.
Shannon,
hope you didn't get tired of waiting.
Yeah, right. I know. Hopefully he's still there. Okay, let's try him now one more time. Hey, Jeff, you're live on Financial Issues.
Oh, hang on. Yeah, I'm here.
Hey, there you are.
All right, you're live.
Brother.
Okay, cool. I don't know what. Good morning, and I have two questions. The first one, I am 72 years old, and in growth and income, I have 2% of my portfolio in small caps, and see, there's no allocation for that in this model. It is MF 29, and I'm down $1,500 in it. Should I wait to sell it, or should I just wait? Let it go up, or because obviously it's not in my model anymore.
Yep. So what I would say is you are your own portfolio manager, so you get to make all of the calls. You can keep it if you want. You can not keep it if you don't want to. If you do sell it, if you're down in it, you can always think of that as a sideways move. So, if you're selling something that's down and you're moving into something else that's down, then it's sort of a sideways move. And you do, if it's in a taxable account, then you do get to capture that tax loss and use it to offset any other gains that you might have. So the rationale behind this is we have two different strategies. We have one where you kind of build your own portfolio, and we have one that is comprised of mutual funds and ETFs, which is a less hands-on approach where you're using professionals to do that. We've had some of the funds and ETFs in the investment model. We're going to continue to have some of those in there that cover areas that we can't, as an analytical team, really do efficiently. So there's some things that are some funds and ETFs that will stay in our individual model, but for the most part, the goal there is to build your own portfolio out of individual securities. So we're starting to kind of wean out the funds that we are really kind of duplicating. So with some of the funds in there, like the large cap, the one that you mentioned, you could be duplicating. So, you may end up with too much small cap exposure if you're picking some of the small cap stocks that are on the buy list. So it's up to you. There's nothing wrong with the holding in and of itself. It's just really trying to streamline the process, where if we're building a portfolio of individual securities, we want to try to keep that as pure as possible and keep the funds and the ETFs in that model.
Right. Overall, I've done remarkably well with your strategy. I just can't thank you enough. And this is just one that, it's not doing well. And, I like to have it clean the way that you present it. I guess maybe at times I'm a little more, just want to get it done now. Patience is a virtue. I have one little question, and I'm way heavy in utilities. What would be I have 6 stocks in utilities. I'm trying to bring it down. I got to bring it down $40K. And I'm not sure some of them doing well, some of them aren't. Is there just any kind of rule of thumb that I could look at a utility? I know you'll say probably not. Don't get rid of the ones that are duplicating. But other than that, I'm really a little confused on what I should reduce on my utilities.
The first place that I would start is to see if any of your utilities are really out of range. Like if you have more than 5% in any one position, I would start there. If you did, I would pare that back. And then you may want to make sure that you have enough diversity in the subsector or the industry. Sorry, I keep calling it subsectors, but in the industries, because if you have stocks that are very similar and they're all doing well, it's very likely that when things change for that sector or for that subsector or industry, that they'll all move in lockstep direction. So you want to make sure you have plenty of diversification there within that. I wouldn't necessarily look at, I don't think it's a good idea to say, well, I'm going to keep all the ones that have done good and sell the ones that haven't, because as business cycles ebb and flow, different industries or subsectors are positioned to do better than others. So, you may have some utilities. The utilities that have really done well are the ones that are geared towards serving those data centers and the whole AI movement. So, you may want to have some that are kind of out of favor that haven't really done as well. You don't want to necessarily get rid of those, especially if they're on the buy list or the broad list.
Right. I know the UT46 is one of those that's just gone wonderfully up. It's really gone up.
Yeah, I think.
But I have others that haven't. I'm just kind of hanging in there with UT66 and a couple others, UT89. But whatever. Okay. Well, I'll try to get these ducks lined up. But thank you for all you do, and you guys are certainly a blessing to us all.
Thanks, Jeff. We appreciate your support, your partnership, and your encouragement. I'm sure that you've encouraged somebody else out there listening that they can do it on their own as well. Well, folks, we have Craig Haugaard coming in with the Ag Report. After Craig, we're going to take a short break, but then we'll be back.
This is Craig Haugaard with your Financial Issues Egg update for June 13th. Well, yesterday the trade's attention was focused on the monthly USDA supply and demand report. And for corn, it was perhaps the least eventful report in recent memory. As expected, the USDA increased exports by 50 million bushels, which dropped the 2025 projected carryout to 1,365 million bushels. The report also left South American production unchanged from last month's numbers. July corn responded by closing a penny and a half higher at 438.5. The USDA left the projected 2025 soybean ending stocks unchanged at 350 million bushels. Now, after the report was released, we saw prices come under pressure with rumors the House would release the renewable fuel volume proposals today on Friday, and that quotas were going to be less than anticipated. Well, today should reveal how accurate those rumors were, but yesterday at least they caused July beans to close 8 1/4 cents lower at 10.42 1/4. The USDA report for wheat featured slightly larger supplies, unchanged domestic use, higher exports, and lower ending stocks. The projected ending stocks for the 2025-26 crop year were dropped by 25 million bushels down to 898 million, but that's still 7% above last year's ending stocks number. Minneapolis July wheat was 3.5 cents higher at 6.20 3/4. Kansas City dropped by 3.5 cents, closing at 5.22 3/4, and we had Chicago 7 3/4 cents lower at 5.26 1/2. Cotton futures remain range-bound. December ended yesterday's session 18 points lower at 67.47. And livestock futures were mixed. August live cattle were $1 7.5 cents lower at $216.95 per hundredweight. August feeder cattle were 17.5 cents higher at $311.25 per hundred. And we had July lean hogs a nickel stronger at $108.90 per hundredweight. Class 3 milk futures continue to work lower. At the closing bell, we had July futures down 5 points at 18.20. This has been Craig Haugaard with your Financial Issues Egg update. We'll be right back with more financial issues after this.
It's up to us to stand up and say, enough is enough. All of this unbiblical stuff that's going on, whether it's abortion or transsexual or LGBTQ, widespread pornography, human trafficking. Bottom line, it's still up to us. If we stop investing in these corporations that are trying to destroy us, sooner or later they're going to wake up.
To learn more about biblically responsible mutual funds and ETFs, go to timothyplan.com.
Preborn is making motherhood possible for thousands of moms across America.
I found out that I was pregnant. My family, you're not having this baby. I met Miss Linda. She offered to get me an ultrasound. That's where I very first heard the heartbeat. It was really a great thing that I was led to the choice to keep him.
To find out how you can support the life-saving mission of Preborn, go to preborn.com/FISM.
Through Crossroads Kids Club, lives like Dali's are being changed all over the world.
When I was 8 years old, my parents separated temporarily, and my mom and I moved houses. But I started to discover pornography that helped me develop behavior that was rebellious, immoral, and bad. It made me feel lost, empty, and without direction. Until one day, I went with my cousins to the Crossroads Club. I really liked the Bible teachings, how they mixed them with games and fun. This led me to know Lord Jesus and accept Him in my heart. He forgave me and changed my behavior. He changed my life, and I don't feel lonely anymore.
Reaching kids with the hope of the gospel in schools and across the world. You can change a young life today at reachourschools.com.
The opinions and recommendations expressed on this program do not necessarily represent the opinions of the station or any of the program sponsors. Additionally, all products or services offered by the program sponsors may not be known by the program.
Welcome back to Financial Issues. I'm your host, Shana. Thanks for sticking with us today. We're in the home stretch of the program. Phone lines are open. 610-363-1110 is the phone number to call. If you call in the next 60 seconds, we can get you in today. If not, you'll have to wait till next week. All right. Rob's been waiting patiently. Rob's calling from Ohio. Hi, Rob. You're live on Financial Issues.
Hello and good morning. Happy Friday to you.
Good morning.
Hey, Rob.
Would be so to set them up a portfolio for themselves, get that started in Financial Issues. What do I need to do inside the website and
to set up their own portfolio?
Yeah, to set up I have a 16-year-old and a 12-year-old, and I'm planning on starting them out with $500 each, and buying them a aggressive, probably technology stock of some sort to get it started.
Okay, that sounds like a good idea. So on your portfolio tracker, you can set up multiple portfolios. And so you could set up one and you could name it as the one as that, and you can kind of start to build the portfolio in there. I think if you're going to be following, you want to look at the time horizon. So you got to ask yourself, when am I going to let the child use the money? If you do, and I think one of the reasons that it was suggested to not put it in the kid's name is not so much for college loan purposes, because they tend to look at the parents' assets as the children's too. But it has to do with when control is given over to the kids. And so if you set up a custodial account, ownership is always with the kids. It is an irrevocable gift. So once you put money into the account, you're not supposed to take it back. You're supposed to use it for the care and custody of the kids. And then when the kids become the age of majority in your state, whatever age that is, then all they really have to do is, present their documentation, and then the ownership and the custodian is removed, and they get to become in control of the funds. So if you have concerns about, maybe they won't be the best stewards by the time that they reach the age of majority, then maybe you don't want to do that. But I think that's a great thing. If they have any kind of earned income, I would suggest a Roth. I mean, even if they just have grass cutting money, or they do babysitting, or clean up, if you own a business, clean up your office or different things like that. You can find ways to pay your kids so that they have earned income, and then they can contribute to a Roth where you can be set up as the custodian. I don't know what their level of interest in companies are. I was just I was talking to Seth during the break, and I was saying, it's I have a 12 and a 14-year-old, and neither one of them are really interested in what I do at all, which is kind of disappointing. But I had to stop and think back, and I didn't really get interested in stocks until I was a senior in high school. I had a really great economics teacher, and she invited, way back then they were stockbrokers, but she invited her stockbroker in to come and talk to us, and we did these 6-week projects where we got to build our own portfolio. And so we had a motivation to learn about stocks, and that really stuck with me. Some people obviously didn't care much, but it stuck with me, and it became a part of what I do in as my career. So that would be something. If you have a child that's interested, you could bring them in. You could show them the website. You could start to teach them about the asset allocation models. You could have them, watch some of the videos about how to get started, learn about the time value of money, the rule of 72, and all of those things. So it's, that's a great way to leave a legacy, is not just by leaving your children money. I mean, what good is leaving your children money if you haven't taught them how to be a good steward of it? So I commend you, Rob, for what you're doing and trying to get those kids not only to put some money back, but to learn how to handle that money in a good stewardship kind of way.
Terrific. Thank you so much.
All right. Thanks for calling.
Thanks, Rob. That's awesome, Shana. You just love to hear that stuff.
I do.
Want to pass this on to the next generation. Yeah,
I do. And not just the money, but the wisdom of how to. That's right. Even more important. I mean, if you had to pick one or the other, if you didn't have the money to leave them, it's actually better to leave them the wisdom, because once they accumulate their own money, then they know how to handle it as well.
Well said.
All right. Let's see if we can get Joe in. All right. Joe's calling from Kansas. Hi, Joe. You're live on Financial.
Good morning, and we appreciate you here in Kansas. Shana, it's good to talk to you and Seth. And again, we appreciate all that you all do.
Thank you, brother.
And happy Father's Day to Seth.
Oh, thank you, Joe.
Sam.
Same to you, brother. Thank you.
Yes.
Hey, my question is, was MA 55 and MA 5 the materials or ETFs and all that they are? My wife and I, in our 70s, we're going to retire, maybe in the next 6 to 12 months. And so I'm moving slowly into the income allocation. And my question is, should I stick these two in the Roth brokerage or traditional IRA?
Do you have space in all of them?
I can fit them all in there. And I'm not. They'll fit.
Okay. My preference would be either the Roth or the taxable account, not really the IRA. And the reason for that, so it depends on how much room you have in your Roth. I would rather see your technology stocks, any healthcare stocks that you have, and if you picked any off of our list that show aggressive in the style box, like all the way over to the right-hand side, if any of those say aggressive, those would be in the Roth ahead of the two that you just mentioned. But if you've got all of your aggressive holdings in your Roth account and you still have room, then I think these would be good to put there too.
Okay, good. With that also, with the caller you had earlier, he talked about small caps, asked you questions about that. And the small caps, I think also we've had micros even on the buy list.
Yes.
Those would end up on the Roth preferably, wouldn't they?
Sometimes. Some of the micro caps that we have had have more of an income bent. So you just want to, look at that part too. That's going to be in the style box as well. So if it's aggressive, if it's marked aggressive, for me, it's kind of a no-brainer. That goes in the Roth. The income stocks are going to go in the IRA. If you have any ETFs, those typically go in the taxable account because ETFs tend to be a little bit more tax efficient. So, and then you kind of work from there because everybody's got kind of different percentages in the different kind of accounts, and it makes a big difference on what kind of money you have available. If only 10% of your entire portfolio is held in your Roth account, but maybe you want to have 15% in aggressive, I'm not saying that you do, but if you do, then of course everything in your Roth is going to be off of that aggressive list, and you're going to have to kind of look at it that way.
Okay, excellent. Okay, well, thank you all so very much. Again, we appreciate all you all do there, and our allocations. They're doing great.
Thanks, Joe. Thanks for the question. Thanks for the encouragement, not only to us, but I'm sure you've encouraged other people too to maybe take that leap of faith and become a partner and become their own portfolio manager. All right. Do we have time to get to any of the questions?
Yeah, let's squeeze this quick one in here, Shana. Brian asked this on the chat. He's saying, if we have stock holdings that now have a balance less than 1% of our overall portfolio, should we add shares to get above that 1% if it's still on the broad list and we also need to increase that particular sector?
Okay, so he checks a couple of boxes for me there. If you still need to add to that sector, that's a check in the yes box to be able to add to it. If you already have plenty of stock, then that is a check in that box too. But then I have to say it kind of depends on what company it is. If it's a company that is on BRI Watch, and you can find that in the FISM opinion column where it says buy, hold, there are some that say BRI Watch. I would avoid adding to those simply because anytime if they continue down the path that they're headed and become no longer biblically responsible, we would ask you to sell. All right, folks, I hear the music. That means we're at the end of the program today. Come back next week because, Lord willing, we're going to be here to remind you that time is getting short. The Master's coming back, and there's going to be a test. We want to help you be found a good and faithful steward with everything that the Lord has trusted you to manage. I'm your host, Shana Burke. Find out more about financial issues at financialissues.org.
If we ever forget that we're one nation under God, then we will be a nation gone under.
Thank you for joining us. This has been an FISM production.